Treasury yields rose again today after the Labour Department released stronger than expected weekly jobless data. Joining us now, Jeff Sherman, Deputy Chief Investment Officer at Double Line Capital. Jeff, good to see you as always. Thanks for joining us.
Yeah, thanks for having me, Wilfred.
What's going to move yields more, the jobs print or CPI next week?
Well, both of them are very important numbers. As you said, with the jobless claims, and everybody focused on the initial claims and these, the downward trend there. But what we've been following for the last 18 months is the continuing claims. And these are people that continue, by definition, to receive unemployment benefits. And given that the extraordinary measures from the COVID and CARES Act that took place last year expired around Labor Day, we're finally seeing that data trickle through. And there's been a significant drop-off in the number of claimants there. In fact, last week, you saw roughly 6.5 million people drop out of receiving some form of benefits, and an additional million or 1.3 million today come out. So we're talking about roughly 4 million people receiving benefits in the most recent print, versus where we were at 12 million plus. So I think we're at a really big juncture here to see if the consumer can stay on their own and what that means for the labor market. But as you mentioned as well, CPI is definitely on investors' minds. And, the Fed, talking about their target for inflation that's going to dissipate next year, it's like 2.2%, is very puzzling to us and trying to figure out how they think it's just going to dissipate and these transitory effects are going to disappear overnight. So I think both of these things are very important, and I think it really sets the stage for a catalyst for rates to move, and that's to the upward side.
Why have rates been moving higher and backing up like we've seen, Jeff, in the face of GDP downgrades, slower growth?
Well, if you think, you think about it, it's a mixed bag here too, Sarah. So what you've seen too is you've seen improvement from the Delta variant, right? You've seen really an uptick in vaccination rates globally. And further to that, we've seen a lot of improvement in just economic sentiment as well, right? Look at the jobs numbers, look at the ADP report this week. And again, I think the bond market is really digesting inflation. So a lot of those headwinds you were seeing really towards the end of the second quarter and really throughout most of the third quarter are really, some of those are dissipating. Yes, GDP is being downgraded. Then again, you're still talking about a growth rate that's running an annualized rate of 3.5% to 4%. So even with the challenges we've seen with supply chains, with the COVID new wave with the Delta variant, well, ultimately all of those things really drove yields down in the second quarter, and now we're starting to see that recovery. And don't forget that you're seeing this recovery in the rest of the world as well. You're starting to see the opening through the Eurozone. You're seeing higher vaccination rates within emerging market countries as well. And you're really starting to see economic data improve globally. So yes, there's been some downgrades, but remember, we're coming off of extremely high levels in the second quarter.